This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 5th. Some highlights from today's show. US long bond yields are creeping down. The ECB is to keep the door open to further rate cuts, and the S&P 500 is shrugging off bad data. Good day, traders, and welcome. And let's start off and talk a little bit about yesterday's session. As we mentioned in the rundown yesterday, we expected a quiet session, and that's exactly what we got. Ranges contracted even more than what we had at the start of the week. The S&P was very, very well contained in such a narrow range. And again, this speaks volumes to what the market's actually paying attention to right now, which is that non-farm payroll print, of course, on Friday, and then, of course, the CPI data out of the US next week. Those are the two key risk events. That's all the market cares about right now. Why? Well, because the reality is everyone wants to know, has that slowdown from Liberation Day begun or not? Okay, does it exist or not? I mean, everyone's just waiting for the hard data to clarify and lift the veil of uncertainty. That is the theme. That is what the market wants to know right now. And until we get that non-farm and beyond that non-farm payrolls, as well as that CPI data print, the markets are going to sit idle waiting ultimately. Okay, now let's get stuck into our first topic discussion for today, because I think it's very much centered on this idea of inflation and growth and hard data in general. Now, this is an article all about the disinflationary forces that are gripping the rest of the world. Now, when we say rest of the world, we're excluding the US from this, because what this article goes on to look at, it kind of looks at the likes of China as well as Europe, looks at their inflation. And by and large, inflation is back at target for both the US, for both Europe and, of course, China, which has been going through quite a significant disinflationary process. And so what this article is about is it's looking at the OECD that's now revised down, their sort of global inflation from 6.2% last year to 3.2% this year. But what they are kind of pointing out is that the US remains, sort of the exception to the rule, which is they are experiencing very, very hot inflation in comparison to the rest of the world. Now, I think what's interesting from this article is they're talking about both the OECD as well as Goldman Sachs are talking about what their expectations are for inflation as we move into the second half of this year. And it's very much pointing towards inflation around that 4% mark. Okay, now why does that matter? Well, look, at the end of the day, President Trump came out yesterday again saying, look, Jerome, you're late to the party. You need to cut immediately, and the Fed desperately does want to cut, but they're well aware of the fact that inflation is going to creep higher towards 4% by the end of this year. So it's not really going to be a good look to be cutting interest rates with inflation expected to tick up to 4% this year. Moreover, if they dare to cut interest rates with inflation where it is, you will see, of course, a very, very aggressive steepening of that curve. You'll see the 10-year and the 30-year sell off quite aggressively. I think that's something to stress to all of you as traders. Right now, the bond vigilantes are sitting waiting. They are almost looking at tomorrow's non-farm payrolls print and saying, look, we actually hope it comes in weak, and we hope the market suddenly tries to get ahead of pricing and rate cuts, and we hope that Chairman Powell cuts, because that's going to give us the ammunition to really get stuck into the long end of that bond curve, because there just simply isn't a pathway right now to be cutting interest rates given where inflation's going. Okay, it just doesn't make sense. And this is ultimately the problem that the Fed faces, is that whilst they do want to cut to support growth, to perhaps support the labor market at some point when the labor market shows weakness, the reality is they won't be allowed to, given the dynamics of what's going on in the bond market. Okay, now with that in mind, let's actually segue and talk about the bond market, because we have actually seen now for the last sort of week, we have seen sort of the yields start to drift lower again. Now, there's nothing really dynamic going on here, but don't forget, we were trading 2 weeks ago around 462. Now we're at 435. So there's still quite a bit of bond volatility, or at least volatility in bond yields currently. Now, what's ultimately driving this, and what's driving this little bit of flattening in the curve? Well, it is the series of weak data. Okay, we are starting to see some of the hard data filter through. Starting, of course, we saw the initial jobless last week tick up quite a bit, quite poorly. We saw the API data this week, and we also saw the services data, which was really, really horrific yesterday. It was a really shocking number, and it is pointing towards, sort of this weakening effect that the markets are expecting. Okay, as a result, of course, of the Liberation Day, the markets are expecting a softening in the data. Now, the key to this is ultimately to watch and keep a close eye on how these yields continue over the next couple of days. But more importantly is to also look how the equities trade in relation to this, because I think there's a very important clue right now, which is yesterday's PMI data was weak. It was a bad print. And yet the equities shrugged it off completely. Okay, now why is that? Why are equities shrugging off weak data? Well, it's quite simple. If the data weakens, there's this belief that the Fed will be more inclined to step in and begin the process of cutting. Now, when we combine this idea of a Fed removing restrictive policy, cutting interest rates at the same time as, of course, 6 to 7% deficit spending for the next 2 years, that is rocket fuel for the equity markets. Okay, so what I'm leaning on, and this is something we're going to talk about quite a bit as we go into tomorrow's non-farm payrolls, is that it's almost like equities go up in all scenarios tomorrow for the non-farm print, barring a very bad print. Okay, so barring sort of a sub 50,000 or negative print, I suspect equities in a bit. Why? Well, because it's simple. So long as the labor market holds up, so long as we can keep printing 100,000 plus jobs every month, the reality is that's a good enough labor market, and more importantly, if we get a little bit of softening in the labor market, it will open the door for the Fed to begin the process of cutting again. Okay, so just very, very important to stress that is that should we get those weaker prints, unless they are significant, I do suspect equities have got all the ammunition they need to continue the rally higher. Okay, now let's talk a little bit about another thing that's also really kind of supporting this narrative I'm pointing out, which is things are not as bad as what sort of Twitter land seem to make them out to be. If we look at junk bond yields, we can see pretty much, yes, we had that Liberation Day concern. We had those junk bond yields spike all the way up to around 8.5%. They're now all the way back and lower than pre-Liberation Day. So Liberation Day started around that 750. We're now trading 725. Okay, so barring all things being equal, if we go to the bonds ultimately, and we look at where Liberation Day started in the bonds, we can see that effectively we were trading around that 425 in the 10-year. Okay, in other words, right now corporate bond spreads, okay, are back below the yields that were trading pre-Liberation Day, whereas 10 years are somewhat higher. Okay, in other words, credit spreads have narrowed since Liberation Day. Okay, with credit spreads narrowing, that's not exactly a bad situation. That's not exactly pointing towards an imminent recession. Okay, and that's the point, is that it doesn't seem to be that bad right now in corporate America. And until things shift, you've got to accept that there is the 6 to 7% deficit spending incoming, and that is going to be rocket fuel so long as we don't tip into an imminent recession. Okay, it's almost like the thesis now for risk markets is, so long as there's not an imminent recession, we're good to be buying, and we're good to be buying back up towards record highs. Okay, now today's all about ECB. It is the ECB. It is the key risk event for the day. Now, I say key risk event not because it's necessarily likely to have any kind of fireworks. It's probably going to be boring as per usual, but there are a few things to keep an eye out for. Okay, now what do we expect? We expect a cut that's fully priced. We expect Chairman Lagarde to be quizzed on ultimately what comes next. I think that's going to be the key theme for today, which is, can you cut in July? Will you cut in July? Are you pausing indefinitely? It's going to be all about the forward guidance beyond today's meeting. That is the key theme. That's what everyone wants to know. Moreover, I think there's going to be a lot of questions about Lagarde, are you stepping down? Are you going to quit ahead of your term and all those sorts of things? So that's going to be the general, sort of talking points when we get beyond today's meeting. But I think there's two sort of sides to the story. The board is quite split. I suspect we won't necessarily have, we may have a unanimous outcome today, but I suspect at future meetings we may not get a unanimous outcome. But I think the general consensus on the board is the doves are talking about inflation that's now going to dip below target over the next 2 years. which is concerning given the ECB's track record of actually having inflation at target. And the hawks are going to talk about this big spending package coming from Germany and all this fiscal spending for defense spending and that impacting inflation, of course, as we move into 2026. Okay, so the hawks are saying it's fine, we're neutral, let's stop, we don't need to go any further. The doves are saying, well, look, we've got this tariff situation, growth is a concern, and of course we are going to undershoot our inflation target, so we need support and go slightly below neutral. Okay, who's going to win? We don't know. Will we find out this meeting? I don't think so. I think right now Lagarde's stance has been over the entire year has been quite straightforward, which is I want full optionality, I'm not committing, I'm going meeting by meeting, and that's not going to change today. Okay, uncertainty has not lifted in terms of tariffs, and it's not going to lift anytime soon. Trade negotiations are of course ongoing. We do have of course have got the 4th of July and the 8th of July to contend with when those reciprocal tariff deadlines end effectively. So right now there's absolutely no case for Lagarde to come out and say with a great degree of confidence that they are going to pause. Because should things take a turn for the worst, of course, in the next 6 weeks, they do just want that optionality. Okay, and I suspect that's what it's going to be. It's going to be, yes, we move meeting by meeting. We are data dependent. If the data warrants it, we can cut again in July. And ultimately, we will just let the data guide the decision making. If the data doesn't warrant it, we could, of course, pause. Okay. Now, again, is any of this news, any of this market moving? Absolutely not. It's very, very well understood by the market. But I think there's a couple of things to watch out for in the actual statement dump. Keep a very close eye on this sort of tagline of data dependent and meeting by meeting. I think so long as that remains in, it keeps the door open to a rate cut in July. Should they drop this meeting by meeting? Okay, so should they maintain there will be data dependent but drop the meeting by meeting? I suspect that means they are signaling the pause. And yes, if they are signaling a forward guidance pause, the market is going to move a little bit hawkishly on that. Why? Well, because it means they're quite confident that they won't need to cut in the near term. They're quite confident that they are at a point now in terms of the cutting cycle where they may not need to support the market any further. Okay, so yes, they dropped that meeting by meeting. It will be taken a little bit hawkishly. Where do you want to be trading? Well, of course you want to be trading the euro dollar because it is the best performing G10 currency against the dollar this year. Okay, we will find our way up the page quite nicely. It is of course a market that's technically very bullish, and these sorts of fundamentals, a hawkish pause will ultimately send that euro back up towards the highs made in May. Now, one thing to point out is that the Nomura economists are talking about the swaps curve that are currently sort of pricing in the ECB missing their inflation target over the next 2 years. And this will, of course, be concerning. Okay, it's very, very concerning. And one of the things I flagged yesterday in the rundown was I said you've got to keep a close eye on break-evens beyond this meeting. Okay, obviously, we've got to contend with today. But then what comes next over the next couple of days is going to be crucially important. In other words, the market's verdict of whatever the ECB says today. Okay, if they come out and they're quite hawkish in terms of, we're pausing, and they're quite adamant that we're pausing in July and there won't be a rate cut in July, they rule that out. I do expect those break-evens are going to perhaps sink a little bit lower. Okay, and I think that's going to be key. If they do sink lower, below that 2%, the market's in essence telling the ECB, hang on a sec, you're still too restrictive. You might think you're neutral, but the market needs additional stimulus. Okay, and that's ultimately what you want to watch out for now. Now, of course, it could do absolutely squat diddly do. Okay, this market doesn't exactly move up and down a great deal every day, but the reality is you've got to watch these break-evens because the break-evens will tell the ECB whether or not they will need additional cuts later on this year or not. Okay, and that's the key thing to take away from that chart. Now, in terms of data today, there is one to watch, and I think this initial jobless plays a little bit of an outsized importance today simply because of what we had with regards to ADP, what we had with regards to the employment index of the manufacturing services data yesterday. Both of them pointed towards some softening. Okay, and I think that's why this initial jobless is very interesting. Don't forget as well, last week we had quite a big tick up, quite a big surprise beat on the initial jobless. Now again, initial jobless is typically not something as day traders we ever look at because it's boring, but it's crucially important when you're trying to, I don't want to say front run a recession, but when you're trying to get an idea of the real-time data where there is this potential for a sudden slowdown, the initial jobless becomes a fantastic real-time indicator. Okay, because it's released week by week and it's physically people just going and saying, look, I'm unemployed, give me some benefits. Okay, so this is why we keep a close eye on it. You can of course see we're up at that 240, which on an absolute level is not alarming. It's the speed. Okay, it's this purple line. It's this 4-week average that we pay very close attention to. If you go back and you look, of course, where I've got this arrow, that was, sort of April, May, June, July last year, and you can see how steep that 4-week average got. And that was, of course, that little mini slowdown, that little mini panic that we had in the middle of last year, which ultimately led the Fed to cut 50 basis points. Okay, so keep an eye on it. What are we looking for? 235 is expected. I think any sort of a print above 250 is going to, again, it's going to be another head scratcher. It's going to be one of those, what's going on? Yeah, okay, but this is the key takeaway. Right now, yesterday we had a pretty bad manufacturing print, and yet the equities completely shrugged it off. Okay, a little bit of a doji day there, but we closed unchanged, which was very much a head scratcher. I was quite shocked. I was trying to sell the S&P thinking, hang on a sec, they should just, expand this range a little bit, and yet it got bought up so aggressively on a dip. Okay. What does this point to? Well, it points to a market that's shrugging off bad data. Okay, and this is what I was leaning on earlier to say that it's almost a case of so long as the data is not horrible, the equities are going to keep staging that, but they're going to keep buying up this dip. And like I said, if that non-farms comes in line tomorrow, guess what? 6,000 is going to go. Okay, all we need is an inline print for non-farms tomorrow, or even a slight beat, and 6,000 is going to go. We are going to stage a significant rally on a small beat in non-farm payrolls tomorrow. Okay, and this is the key. The market just needs that confirmation that things are not dropping off a cliff, and that will be enough to take it higher. So again, I think today is very much watching that 6,000 level. I don't expect anything great to happen today. I do expect they're going to try and test and break above the 6,000 level. Watch closely. Okay, I'd be very cautious buying above 6,000 today. It's not the day to do it. Why? Because non-farms is the key event for tomorrow. Okay, no one is going to be aggressively positioning themselves for a breakout today, not ahead of that non-farm payrolls. If anything, I'd watch closely around that 6,011 level. There's quite a big strike there, quite a bit of hedging activity going to take place from all the gamma exposure up there. So keep an eye on that. I do expect another day of very boring trading, but like I said, I think we'll probably test and challenge that 6,000 level, perhaps a little bit of a day trade, a little bit of a scalp to the upside, at which point we settle into narrow trading ranges. Okay, with that in mind then, of course, there's a lot going on. Well, there's not a lot going on, but of course we need to just keep our eyes peeled for some of the commentary. Don't forget, of course, we are waiting to see the response from Russia. There will be some form of an attack on Ukraine. We need to know what that is. We were, of course, talking in the Discord channel yesterday about some form of a mini nuclear or small nuclear attack to really send a signal. Now, again, this is not a base case. This is not me wanting to post alarming, but keep in mind, anything nuclear, anything that escalates and is quite a large degree more dramatic will, of course, put a little bit of an offer in the risk markets. It will be concerning at a time when, of course, the VIX is trading sub 18. So keep a close eye on that. Of course, we also need to find out the first country that's going to get its response to its letter, sent by the US, and we need to know what that looks like. We need to understand what that is to understand the playbook of the US administration. So that's another key piece of headline to pay very close attention to. With that in mind, if there are any comments, do post them in the YouTube comment section. Don't forget to like and subscribe and share the channel. It does, of course, help us grow the audience. Otherwise, good luck out there. Manage that risk. Go make some money.